The big number we've all been waiting for, Q2 GDP from China, coming in a bit hotter than expected at 7.5%. HSBC's Zhu is joining us now. John, you expected a bit of a cooler number, actually. So what does this say about the patchwork stimulus we've seen from China?
I guess it says that the effects are coming through perhaps slightly faster than we had expected. So we had always thought that the stimulus will eventually lead to a pickup in growth and activity. It's just that it's come through in the Q2 numbers. So on the whole, it's still for the whole of the year remains on track to meet the 7.5% target or thereabouts.
Okay, so we're not going to see a hotter H2 going in.
No, I think we'll still see a continual pickup in H2, judging by some of the leading indicators. And the one thing that people haven't really been discussing is perhaps external demand gradually picking up. Now, we've been disappointed before in terms of world trade cycle, but on the whole, I think Europe and the US probably can't get too much worse, and if anything, the sort of balance of risk around that side is perhaps on the upside.
Right. Now, when you talk about external demand, I got to bring in the RMB here, because in 2014 we've seen, it's long been a one-way bet. That's changed. It's weakened considerably. What are your expectations for the rest of the year there?
I think from where we are now, around the 6.15 level, not too much change for what it's worth. We think it'll probably strengthen a bit to end up at 6.14 by the end of the year, mainly on, I think, just the better economic data that we expect to come through through the second half of the year. But on the whole, I don't think it's going to be something that the PBOC is using actively to perhaps drive exports. That's not really the best tool. There are a lot of other measures that it can use to boost growth.
Right. Now, they certainly are using tools in terms of stimulus. What do you expect in terms of stimulus for the rest of the year?
I think there will still be some potential for targeted stimulus, but in terms of any big moves, say cutting interest rates or something like that, I think the chances of that are probably receding a little, not just because of today's better GDP number, but for instance, yesterday's monetary data was better than expected. So on the whole, I think the PBOC has kept conditions fairly loose and will continue to be supportive, but on the other hand, no sort of big moves across the board.
In the backdrop of this year's growth, we've seen a lot of action from Xi Jinping, a lot of talk about corruption, reform, and a crackdown there. Does this growth number give him more headroom to do more there?
I think on the whole, this is something that needs to be done anyway. So obviously having a stronger economy is always good for any sort of reform that you want to do. But in terms of changing norms and having a better institutional framework, that takes time. 1 quarter or 2 quarters of economic data doesn't really change that, I don't think.
One thing we have seen, though, is amid this nice data we're seeing today, weaker property numbers. The prices are falling down on average in China. How much of a risk is that?
It's certainly one of the main downside risks around our forecast. The question is what can offset it. I don't necessarily think the government wants to reignite the property sector, especially in areas where a correction is probably healthy. But to sort of keep growth around a reasonable level, you'll probably want to perhaps increase investment in other areas, say infrastructure, so that on the whole growth is still reasonably fast and the economy keeps going and employment keeps growing as well.
So they're okay with a small correction, but at the same time we're seeing, for example, the developers who have been relying on these trust funds to fund their activities through the shadow banks. That money's drying up. And given the the connection that property has with the rest of the broader economy in China, is that a big concern?
It is a concern, but I would like to think of it as, what is the main structural problem here? It's not so much shadow banking, which in our view is a symptom of a much more fundamental issue, which is that China's credit market is still has unfinished reforms. And I think tackling the problem at source, i.e. pushing through financial sector reform so that property developers, for instance, can get much more access to traditional bank lending, for instance, would be a better way of doing it than, say, micromanaging the demand side. So I think certainly a worry, but how you tackle it also matters.
All right, let's see how they do that. Thank you so much, John.
Pleasure, thank you.